Welcome back to another episode of the Dividend Journey here on Financial Friends. I want to start out by saying thank you everyone for the support. It has been amazing thus far, and I do want to shout out myself down in the description below. You can go ahead and check out Financial Friends on all of the social medias, Twitter, Instagram. There's a podcast on Anchor, Facebook, TikTok, you name it, we have it. Go ahead and check that out in the description below. I would appreciate any and all support, as well as like and subscribe. There's going to be more content coming out very, very soon, every Thursday. So every Thursday, we're going to be adding some content here on Financial Friends YouTube page. So make sure you join, make sure you like, make sure you subscribe so you do not miss a thing. And without further ado, let's hop into the portfolio. What did we do this week? So this week we added $5 to waste management, and we added $5 to Fizzrocks. So we did have to average up in our both positions. So we averaged up in our position in Fizzrocks, and we averaged up in our position in waste management. And what does that mean? Well, averaging up in a position essentially means that you purchase the stock at a higher price than you have before. So let's say you've purchased a stock at $100, so your average cost would be $100. If the stock price then goes to $105 and you make a purchase of that stock at $105, you have now raised the average cost, or the average cost of your position, essentially. So we did have to do that in both. Averaging down in a position, say it would be if we bought a stock at 100 and then the next time we purchase would be at 95. And that's what we're looking to do. However, that's not going to be the case as the portfolio appreciates in value. So the poll, here's the poll. If you didn't check it out, there was one on Twitter as well as one here on Public. So make sure you go follow my Public page. It is at Brendan Shima over on Public. And I'm posting every single day. There's content there every single day for me. I'm interacting. I reply to as many people as I possibly can. So make sure you go ahead and check that out. As you can see, there was about 1,100 votes, and Fizzrocks dominated the poll with 44% of the vote. You can just kind of scroll through the comments here. If you'd like to read any of these, go ahead and either follow me over there or pause the video. You can go ahead and read some of these, get some opinions from the people that I value over on Public. I value everyone's opinion there because there's so many different opinions that I'm able to get a true gauge of what people are thinking. So here are some of my replies to everybody. As we keep scrolling through. And there will be another poll here for this video as well. So make sure you go ahead and check it out. I will try and put one up on Twitter as well. But as you can see, Fizzrocks dominated the poll. There were some questions about what is Fizzrocks. So Fizzrocks is a zero-cost index fund. Index fund. Sometimes they're called mutual funds. Those are a little bit different. However, what an index fund is essentially a bunch of stocks into one. So similar to an ETF. However, ETFs are traded every single day and you can purchase them just like the normal stock of a company, whereas a index fund is purchased one time throughout the day. So you might put money in at 9:30 in the morning when the market opens. However, your position will not be filled until afterwards, until after the market is closed, or around market close, at least with Fidelity, I've noticed is when they get filled. So be aware that you're not getting the position right at the price that you hit buy at in that exact moment, like you would be with an ETF or a limit order somewhere else. You're just going to go ahead, you're going to put that in, and it'll be filled at the price it's filled at. So it's a bit more for passive investing. However, the reason that Fizzrocks is such a cool position to have in the portfolio is there's no expense ratio on it. So with ETFs, what happens is if they're passively managed, so not many deals are being done, not many positions are being changed, you might get an expense ratio like VU of 0.03 or something like SCHD, I think is 0.08 or 0.06. Don't quote me, but I know it's in that range. And so for those, not much is happening, not much is being changed, low expense ratio. On a ETF like ARKK, which is Kathy Wood's ARK Innovation Fund, she is constantly changing the positions in that portfolio. Trimming positions, adding the positions, switching stocks out completely, selling off, like all sorts of stuff. And so the expense ratio there is 0.75%, because they're actively managing it. So they're going to want a little bit more in return for doing so. The Fizzrocks, on the other hand, is a 0.00% expense ratio. There is no cost to be invested in it. And that is the reason why we are parking some cash in there. We might move some things around at some point and kind of utilize that cash to purchase in or buy dips on other companies. But for now, we're just looking to have some cash parked in the portfolio in a nice stable growth. And they do pay a dividend. It's not a large one, but there is a dividend there. So let's go ahead and hop into our portfolio. Let me just get myself down in the corner here. There we go. So we're going to hop over here to track your dividends, hop over to the dashboard, and I need to be careful. I've had to refilm this a couple times because I keep clicking on personal or summary rather than dividend journey, which is the portfolio we have here. As you can see, the value is $80 and we have an annual income of $2. Now that is rounded up from $1.67. So the true annual income is going to be $1.67. The portfolio has not grown really any in terms of price appreciation, but that's okay. We're going to be in this for the long term. We're going to continue to add to positions. As you can see, we're down in positions right now, like Realty Income, SCHD, J&J, and Waste Management. These positions are just down. This is the day change, and this is our total profit loss here. But we're going to make sure that we can average down in some positions. I also want to talk about here about the annual income. So as you can see, 6 cents, 18 cents, 38 cents, 40, 51, and 14 cents. Those are the numbers we're going to be analyzing. We're going to be continuing to grow those numbers and watching them compound over the course of a few years here, just watching them continue to grow. And that's why I want to take this video next. I want to highlight this future value tab here on Track Your Dividends. So we're going to go over to, not the personal account, but the dividend journey portfolio here. And as you can see, we have a 5-year dividend growth rate of 8.19% and a dividend yield of 2.09%. So we're going to go down here. We're going to calculate some numbers. We're going to max this out at 8%. I want to be a little conservative on all of these numbers. I think 3% is going to be a fair number for price appreciation, but we can play with that. At we'll drop it to 2 as well. And for dividend growth rate, we're going to drop that down from the 8 to about 5%. We're going to be a little conservative here, and we're going to be adding at least $10 every week. So this is going to slide to $520, and we're going to see where we can be at in about 10 years' time. And as you can see, we're going to shoot up to a portfolio value of $5,916. And obviously this is an estimate, but this is what we're going to be, working with. We're going to be kind of playing with these numbers as we go, checking and seeing where we're at. So an annual income of $140, which is nice. But we're going to slide this out now to 25 years, so 15 years down the road, or further down the road rather, making sure that this is all the same here. So adding $520 over the course of those 25 years is going to put us at a projected balance of $25,539 with $801 of annual income. And it's super cool to be able to see going from $2 all the way up to $801 just shows the potential of what you can do. And let's just say we double that. So maybe we add $20 every week. That's going to put us at $1,040 of annual contributions, and boom, that puts us up to over $1,500 in annual income, which is absolutely amazing. So I'm going to be messing with this as we continue to go, as we continue to be able to add more to our positions rather than just the $10. This is definitely going to be something that we are going to look at. I also want to keep an eye here. I just went ahead and purchased the premium version of Track Your Dividends. So this is going to give us a little bit more functionality. In some coming episodes, we might hop in and do some research on stocks, screen some stocks, look for some different ones. But for now, we're going to go over to the Dividend Journey portfolio, and we're going to analyze our dividend safety scores. So any ETFs or index funds are not going to have the dividend safety scores, but our individual positions are. So we can see that Apple has a dividend safety score of 75, J&J of 79. Realty Income Corp is down at 49. Now, there are some different things that have to do with Realty Income Corp. The way that they calculate dividend payout ratio for REITs is very weird. And so it shows a dividend payout ratio. I'm sorry, just not dividend, but a payout ratio of over like 200%, which is not the case. They're not paying out 200% of profits because that wouldn't be correct. Just the formula for the number is a little bit messed up. And we also have Waste Management with a score of 86. So it's looking like the safest dividend here in our portfolio is going to be Waste Management, and the next safest is going to be J&J. So we will take a look at some sector diversification, expected dividends and such here as well. Not that. We'll look at this next time. We're going to look at some expected dividends super quickly because there's something I wanted to touch on. We will be getting paid this month. Not a lot, but a little bit. We'll be getting 1 cent from Apple and about 3 cents from O. And then huge payout here in December for us. So hopefully we can build up our positions a little bit more. And we will see where we can get to in March, because March is going to be our next largest payout period, and then June as well. So we're going to continue to build these dividends and continue to watch the portfolio grow as we do so. But all right, I'm going to definitely go ahead here and blow myself up a little bigger. I'm going to do a little bit more talking before I let everyone get on with their day. I do hope that you have enjoyed this episode of the Dividend Challenge. I also want to touch on the fact that there's going to be a poll. So there's going to be another poll posted. Make sure you go ahead and vote on that. Not sure exactly what the poll is going to be about. I'm not going to give that away quite yet. And I'm going to try and make it something different. So I don't think we're going to be adding a new position next week. We may. Not sure. Go ahead and check the poll. And with that being said, I hope that you enjoyed this video. And like I said, if you're not already, like this video. If you're not subscribed, definitely subscribe. There will be some new content posting on Thursdays, and I will let you guys all know when there will be consistent videos on Thursdays. For now, they might be a little bit scattered, but once I start my new semester here at school, they're going to be every single Thursday, so get excited for that. With that being said, I hope you guys have a fantastic day.